Welcome to The Explainer. You know, we're always told that in finance, smart money moves lightning fast. But what if that's not the whole story? What if the system itself is actually built to slow things down? Today, we're digging into the real reason capital gets stuck in the mud. And trust me, the answer is way more deceptive than you think. Let's get into it.
So this is the big question, right? In a perfect world, money should just pour into the hands of the best investment managers, instantly. But in the real world, it feels more like it's stuck in a 5 o'clock traffic jam. So what gives? Why the massive delay? That's the puzzle we're going to piece together today.
And this leads us to our first big mystery, something economists have dubbed the slow money puzzle. The best way to picture it, imagine trying to pour molasses in the middle of winter. That's pretty much what it looks like when capital tries to move from a bad investment to a really good one. It's just thick, slow, and totally inefficient.
So let's put our name to it. Slow-moving capital is this weird, documented fact that money just doesn't shift gears nearly as fast as the textbooks say it should. I mean, you can have a brilliant manager who's absolutely crushing it, and it can still take years for investors' money to actually show up. And this lag, well, it doesn't just slow things down, it actually creates some really dangerous incentives.
Okay, so just park that thought for a second, because we need to bring in a second piece of the puzzle. It's this strange, risky game that some money managers play, and on the surface, it looks totally safe, but it's hiding a really nasty secret.
The game is called Reaching for Yield. Here's how it works. Imagine you're a fund manager and you desperately need to show some amazing performance, like yesterday. So you go out and buy an asset that pays out these nice, steady, high returns, month after month. Sounds great, right? Well, here's the catch. There's a tiny, almost invisible chance that this asset could just implode, losing nearly all its value overnight. It's like picking up nickels in front of a steamroller. It pays off for a while, right up until it doesn't. And this quote from the economist Raghuram Rajan really hits the nail on the head. When he talks about producing very high alphas, what he means is making it look like your amazing returns are coming from pure genius, not just random market luck. These risky strategies make managers look like absolute rock stars in the short term. And because of that, man, the temptation to load up on them is just huge.
Okay, so let's recap. We've got two mysteries on our hands, money that moves way too slow, and managers who are secretly gambling on these hidden risks. And this is where it all clicks together. It turns out they aren't two separate puzzles at all. The gambling is actually what causes the slowness. To see how this works, let's imagine we've got two kinds of managers out there. First, you've got your skilled manager. This person has real, genuine talent. They can actually find great investments and produce solid long-term returns. But then, you've got the opportunistic manager. This person, well, they don't really have that special sauce. So to keep their job and, attract investor money, they've got to find a way to fake it.
So here's how the whole scheme works. The opportunist goes out and reaches for yield, loading up their portfolio with those sneaky, risky assets. All of a sudden, their short-term numbers look incredible, often just as good as the genuinely skilled manager. Now put yourself in the investor's shoes. You look at both of their recent track records, and you literally can't tell who's the real deal and who's the gambler. The clear signal of actual skill gets jammed by all the noise. And because you're not sure who to bet on, what do? You hesitate. You wait. And that's why the capital moves so slowly. And just let that sink in for a second. It's this incredible paradox. The frantic effort by some managers to attract money is the very thing that clogs up the pipes for everybody, making the whole system of getting capital to the right places less efficient. It's a kind of brilliant, but also a little terrifying insight into how things really work. Now you might be thinking, okay, but eventually investors will figure it out and pull their money from the bad managers. That should fix things, right? We call that market discipline. But here's the wild twist. In this system, that very threat, the threat of being fired, is what makes the problem even worse. Let me show you what I mean.
So now, even our genuinely skilled manager is caught in this awful trap. They basically have two choices. Option one, they can stick to their guns, do the right thing, and pick the best long-term investments. The problem is, because the opportunists are out there jamming the signals, their good performance won't really stand out and capital is going to trickle in slowly. Or there's option two. They can join the game. They can also start reaching for yield to make their short-term numbers look amazing, which attracts capital way faster, even though they know it's a worse long-term strategy. The fear of losing their job pushes even the good guys to make bad decisions. And we're not talking about a small effect here. The research on this is pretty clear. When these kinds of hidden risks are in play, the flow of money to the truly skilled managers can slow down by as much as 50%. 50! That is a massive drag on the efficiency of our markets, and it's all because of this hidden game of performance jamming.
Okay, so this is a really powerful theory, but where does it actually pop up in the real world? This isn't just some abstract idea from an academic paper. It has huge implications for where risk secretly builds up in our financial system.
This whole reaching for yield thing gets way more tempting under certain conditions. First, when interest rates are super low, everybody's desperate for better returns. It's also really common in the more complex corners of finance, like with hedge funds or private equity, where managers just have a lot more freedom. And it absolutely thrives in assets where that hidden steamroller risk is hardest to spot. Think about certain kinds of corporate bonds, or, yep, the infamous CDOs from before the 2008 crisis. And finally, the pressure to do this goes through the roof right after a manager has a bad year and is terrified of getting fired.
So look, if you take just one thing away from this whole explainer, let it be this incredible paradox. We all assume that the fear of investors pulling their money, market discipline, is what keeps managers in line. But what this shows is that it can do the complete opposite. That very threat is what lights a fire under all managers, both the good and the bad, to start gambling with these hidden risks.
And that leaves us with one last, pretty unsettling question to chew on. We depend on financial experts and the free flow of capital to keep our markets efficient and make sure resources go to the best places. But if the very structure of the game encourages them to hide risk and obscure their real talent, it really makes you wonder just how smart the smart money can ever truly be. Something to think about.